Okay, let's unpack this. Welcome back to the deep dive, everyone. We're here again to dig into the complex details so you get the essential insights without, having to sift through everything yourself. Today, we are diving deep into Vertex Pharmaceuticals. They're a biotech giant, really, and they've built this spectacular multi-billion-dollar business, and it's based on treating just one rare genetic disease, cystic fibrosis.
Yeah, it's pretty remarkable when you think about it.
Their revenue stream, it's clocking in at over $11 billion annually.
Hmm.
And, well, it seems incredibly defensible. So our mission today really is twofold. First, we need to understand the true economic durability of that CF foundation, their economic moat, right?
Mm-hmm.
And second, and this is the big question for any investor looking at them, can the current leadership successfully pull off this really aggressive diversification strategy? They call it their second act.
Right.
And it's all about outrunning this defining failure from their past.
That's exactly the tension, isn't it? That's what we need to resolve. Because the market, well, recently it's shown significant doubt about Vertex's future growth.
Why is that?
Mostly because of financial headlines that, frankly, can be deeply misleading if you just look at the surface.
Okay.
So our goal here is to give you clarity, help you separate the real operational risk from what's essentially just accounting noise.
Makes sense.
If you understand the permanence, let's say, of the existing business, the CF part, and the actual rationale behind these new bets they're making, well, then you understand the investment case.
All right, let's start with where the money comes from, the source of the capital. Their revenue model seems fundamentally pretty simple, even if the science behind it is, incredibly complex.
It is staggeringly complex.
They find a fundamental broken mechanism in biology, like this malfunctioning CFTR protein in cystic fibrosis, and then they engineer a very specific chemical or biological key to stabilize it or ideally fix it.
And that key, well, it's generated just staggering reliable cash flow. I mean, we're looking at $11.02 billion in expected 2024 revenue.
Wow.
And almost all of that comes from the CF franchise, specifically their flagship drug, Trikafta.
Okay.
The real power here, though, is the non-discretionary nature of that demand. This isn't something you choose to take. It's life-saving medicine for a genetic disease.
Right.
So demand isn't cyclical. It's tied directly to human biology. People need it.
But, biological breakthroughs, they rarely stay proprietary forever. We hear about patent cliffs constantly in pharma.
Sure.
So how durable is this dominance? How do they actually defend this gold mine?
Yeah, that's the key question. And their competitive advantage, it runs much deeper than just a piece of paper, like a patent.
Okay.
The patents are, let's say, the foundation.
Mm-hmm.
But the real economic moat, that's built on intangible assets, specifically their proprietary R&D know-how.
Proprietary R&D know-how, what does that mean in practice?
Well, we're talking about more than 20 years of accumulated, highly specific, tacit knowledge in CFTR modulated chemistry. This is like tribal knowledge built up inside the company.
Ah, I see.
It's virtually impossible to just go out and buy that or to reverse engineer it easily.
That sounds good in theory, but, where's the proof?
Is there evidence this knowledge base really keeps competitors out?
Oh, absolutely. You just need to look at the failures of big pharma trying to get into this space.
Like who?
Well, take AbbVie, one of the biggest, best-funded pharmaceutical giants globally. They tried to develop a competing triple combo CF therapy.
Okay.
They had essentially unlimited capital, right?
Yeah.
And they crashed and burned spectacularly.
Really?
Yeah, their entire program was discontinued. That shows you just how specialized this chemistry actually is. The only company right now that seems capable of disrupting Vertex's existing multi-billion-dollar CF franchise is, ironically, Vertex itself.
Which leads us to the ultimate sign of monopoly power, doesn't it? The ability to dictate price. Exactly. Because there are no real alternatives that treat the underlying mechanism of the disease, Vertex commands extremely high pricing.
How high are we talking?
Well, Trikafta's U.S. list price, it sits around $370,000 per year, per patient.
Wow, that's a lot.
It is. And independent bodies, the ones that analyze drug pricing like ICER, they've concluded that Vertex possesses unambiguous monopoly pricing power.
That seems like pretty definitive proof the moat is secure, then.
For now, yes. The moat is deep.
So if the moat is so strong, why do they feel the need to engage in what you called self-disruption? Why develop this next-gen drug, Alyftrek, specifically to make their current multi-billion-dollar blockbuster, Trikafta, obsolete?
Right.
What's driving that decision? It seems like they're attacking themselves.
It's a fascinating question. And that decision, it really isn't based on immediate market pressure. It's driven by culture. It's the ultimate expression of, well, internal paranoia. What you're describing there is basically the Red Queen effect in action.
The Red Queen effect from Alice in Wonderland.
Exactly. The biological concept that, you have to run faster and faster just to stay in the same place.
Okay.
And this corporate paranoia, it stems directly from something they internally call the hepatitis C ghost.
The hepatitis C ghost sounds ominous.
It was a defining moment for them. Back in the early 2010s, Vertex launched a hepatitis C drug. It went from $0 to $1 billion in revenue faster than almost any other drug in history. An incredible success.
Okay, so what went wrong?
Well, within about a year, it plummeted right back down to zero.
Zero. How?
A competitor, Gilead, launched an even better cure that rendered Vertex's drug obsolete, literally overnight.
Ouch. That kind of catastrophic, sudden failure, that must leave some serious psychological scars on an organization.
It absolutely did.
Yeah.
And the current CEO, Dr. Reshma Kewalramani, she constantly uses that historical trauma, that memory, to reinforce her philosophy of serial innovation and, crucially, never be complacent.
Ah, so that explains the drive.
Yes. Their aggressive strategic pivot now, this second act, their willingness to potentially cannibalize current revenue for future durability. It's a direct cultural response to the terror of that HCV ghost repeating itself.
Okay, that makes sense culturally. But let's talk about management alignment. It's critical, right? Diversification is the main goal. How are the leaders actually incentivized to shift focus away from the very comfortable CF cash cow into these risky new ventures?
That's a great point. And the incentive structure looks excellent, actually.
Yeah.
Their long-term paychecks are tied to something called performance stock units, or PSUs.
Okay.
And these PSUs, they're explicitly tied to achieving R&D milestones, specifically in non-CF areas.
Oh, really? Can you give an example?
Sure, like management payouts might hinge on goals such as completing 2 phase 2 studies in non-cystic fibrosis disease areas. They're literally paid to solve this diversification challenge.
That's strong alignment.
It is.
And for anyone tracking management signals, there was also that powerful qualitative indicator back in August 2025 wasn't there.
Yes, absolutely. The ultimate skin in the game move, you could say.
What happened?
Dr. Kewalramani, the CEO, made an open market purchase of 10,000 shares. She invested about $3.9 million of her own money into Vertex stock.
On the open market?
On the open market.
Yeah.
Now, insider selling can mean many things. Often it's meaningless, right? Taxes, diversification.
Right.
But an insider buying significantly on the open market, especially at a time when the broader market is expressing some skepticism, that's generally a powerful signal of internal conviction in the strategy. In this case, the diversification pivot.
And all of this risk-taking, this diversification, it relies on having a massive financial safety net, presumably.
Absolutely.
So let's talk about the balance sheet, because from what I've seen, it looks like an unassailable bastion of cash.
It is remarkable strong. I mean, truly. They hold a staggering $12.0 billion in cash and marketable securities.
$12 billion.
$12 billion. And against that, only minimal debt. So this immense net cash position is what funds the entire diversification strategy.
And how did they build that up?
It's built on just explosive, highly profitable growth. We're talking 10 consecutive years of double-digit revenue increases.
10 years straight.
Yep. And with gross margins consistently locked in the extremely high 86 to 88% range. That's where the cash comes from.
Okay, but this brings us to a critical financial wrinkle, something that needs careful interpretation, you mentioned.
Yes.
If you just look at high-level financial screeners for 2024, the numbers look, well, alarming. A GAAP net loss of negative $0.54 billion and negative free cash flow.
Right. And those figures are definitely misleading some high-level observers, maybe algorithms too.
So what's the reality? What's going on there?
You absolutely have to look through the accounting anomaly. That reported loss, it is not an operational failure. Let me be clear on that.
Okay.
It is the mandatory direct consequence of their $4.9 billion acquisition of a company called Alpine Immune Sciences.
Hold on. How does an acquisition create a net loss like that?
It's down to the accounting rules. Under generally accepted accounting principles, GAAP, when a company acquires research and development assets that haven't yet been approved by regulators.
Which Alpine's main drug wasn't yet.
Exactly. A huge chunk of that purchase price, in this case $4.4 billion of the $4.9 billion total, must be immediately expensed on the income statement. It's booked as an acquired IPR&D charge.
IPR&D.
In-process research and development. The crucial thing to understand is that this is a non-cash one-time accounting entry. It hits the GAAP profit, but not the actual cash generation of the core business.
Ah, okay. So if you strip out that one-time charge.
If you strip that out, the underlying operational free cash flow margin remains incredibly robust. It's still sitting at over 30%. They basically took a big hit on paper now to acquire a potentially valuable future asset.
So let's apply the capital allocation test then. Was deploying nearly $5 billion of that hard-earned CF cash to buy Alpine a rational move?
Well, from a strategic perspective, yes. It looks strategically sound. It was a calculated deployment of that, temporary high-margin cash from CF
Right.
to acquire a new, potentially durable, phase 3 ready asset, this drug called Povetacicept, in a completely new therapeutic area for them. Autoimmune kidney disease.
A totally new field.
Totally new. So this move is the ultimate antidote to the complacency that led to that hepatitis C failure we talked about. They're sacrificing short-term paper profit to try and buy long-term future stability and growth.
Okay, so we've established the CF Bastion is secure, financially strong, but the future valuation, it really hinges on the success of this diversification pivot, the second act.
Absolutely.
So what are the key assets that are supposed to be driving this next phase of growth?
The pipeline is pretty expansive now, actually. Key assets include Cura's GY, that's the potentially curative gene therapy for sickle cell disease, and beta thalassemia, developed with CRISPR Therapeutics.
Right, the gene therapy.
Then there's JourneyX. That's their novel, first-in-class non-opioid medicine for acute pain. A huge potential market there.
Mm-hmm.
Then, of course, Povetacicept, the big Alpine acquisition target for kidney disease, specifically IgA nephropathy, or iGAN.
Okay.
And another one is Zimislecel, which is a cell therapy that holds the potential, and it's still early days, but the potential to actually cure type 1 diabetes.
Cure type 1 diabetes? Wow. That's ambitious.
Hugely ambitious, but these are the kinds of big swings they're taking.
But, I mean, drug development is risky. R&D failure must be the primary company-specific risk here, right?
It absolutely remains the primary risk. And we've seen recent setbacks that prove success isn't guaranteed, even for Vertex.
Like what?
Well, one of their next-generation pain drugs, VX-993, failed in phase 2. And the FDA recently narrowed the initial indication for JourneyX, the main pain drug. They want to see it proven for specifically in diabetic peripheral neuropathy, or DPN, before potentially wider labels.
So bumps in the road.
Definitely.
Yeah.
It proves R&D is tough, outcomes are uncertain.
This brings us to some recent earnings reports then. You mentioned the market punished Vertex for what looked like misses on both Casgevy, the gene therapy, and JourneyX, the pain drug.
Yes.
You're saying the market reaction was first-level thinking. What's the deeper, maybe contrarian view here?
Well, the market seems to be fundamentally misapplying the standard quarterly prescription model, counting scripts week by week, to these particular drug launches.
How? So for Casgevy?
Casgevy isn't a pill you take every day. It's a one-time, potentially curative gene therapy. It requires incredibly complex patient scheduling, hospitalization, chemotherapy beforehand.
Right. It's a major procedure.
Exactly. So the revenue is going to be lumpy. It depends on when hospitals can schedule these complex procedures. The market seems to have mistaken this natural, complex lumpiness for a fundamental failure of underlying demand. The demand is likely there. It's just complicated to fulfill quickly.
Okay, that makes sense for a gene therapy. What about the JourneyX non-opioid pain drug? Why the revenue disappointment there?
That perceived miss, I'd argue, was actually a strategic launch investment, not a revenue failure.
Meaning?
Vertex is prioritizing long-term hospital access and adoption for JourneyX. That requires expensive, initially non-revenue generating actions, like widespread free drug sampling to get doctors familiar with it, building relationships with hospital formularies.
So spending money now to build the market for later.
Precisely. They're investing capital rationally now to hopefully secure a multi-billion, multi-decade franchise down the line. But the market, focused on the short term, punished them for making that long-term investment. In a way, they're being punished for acting like long-term compounders.
So if the market is doubting this whole pivot, doubting the second act, what's the single biggest event, the put up or shut up moment, that could validate that huge $4.9 billion bet on Alpine?
For me, the primary catalyst has to be the Povetacicept phase 3 interim data readout.
The kidney drug data, when is that expected?
It's expected sometime in the first half of 2026, so not immediate, but visible on the horizon.
And why is that specific data point so crucial?
Because positive data there would do two things. First, it potentially unlocks a multi-billion-dollar franchise in iGAN, a disease with huge unmet need. Second, and perhaps more importantly for the narratives,
Yes.
It would validate their ability to successfully transfer their scientific and development expertise from CF into a brand new complex therapeutic area. It proves the entire diversification strategy is working, that the second act is real.
Ah, okay. That really explains the current valuation tension then, doesn't it? The PE ratio is sitting around, what, 27 to 29 times earnings?
Yes, somewhere in that range.
Which is well below its historical average. You see numbers over 50x historically.
That's right. The 9-year mean is up around 51.7x.
So the market is clearly pricing in the stability and cash flow of the CF fortress.
Yes, it's paying a premium for that, arguably.
But it's deeply discounting, or maybe even doubting, the potential success of the second act.
Exactly. That Povetacicept data is the hurdle. Positive data suggests the current price might be a bargain. Negative data suggests maybe it's just fairly priced for the CF business alone, or maybe even expensive. So as we wrap up, we really have to connect the core strength we identified, that incredible pricing power in CF.
The $370K price tag.
So to what is probably their greatest long-term structural weakness?
Which is?
Pricing and political risk. Pricing a life-saving drug at $370,000 per year, necessary as it might be to recoup R&D for rare diseases, makes Vertex a permanent, very large, and very visible target for political attack and regulatory scrutiny.
Yeah, you can see how that would attract attention.
It's just structural to their success. You see initiatives like the Inflation Reduction Act, discussions about government price negotiation or setting. These will always be aimed squarely at companies with perceived monopoly pricing power, especially in specialty pharma.
So that pressure threatens to potentially impair their margin structure over the long term.
It's a constant threat. It's a battle they will likely always be fighting, always running that race.
So maybe we leave you, the listener, with this final tension to think about. Is Vertex's extraordinary pricing power in CF the unshakable foundation of a truly permanent, unassailable economic moat? Or is it merely a temporary, politically charged advantage? A bright target that ensures the company will always be running that relentless Red Queen race against regulatory pressure and political scrutiny, just trying to stay in the same place, financially speaking.
A fascinating question to ponder.
It really is. Okay, that does it for this deep dive into Vertex Pharmaceuticals. We really appreciate you joining us on this investigation today. We hope you feel thoroughly informed now and perhaps a bit more ready for your own next investment decision or analysis. We'll catch you on the next deep dive.